Good afternoon, friends. Happy to have everyone here today talking about my very favorite, one of my two very favorite subjects in the world. One of those two is anything financial, and this one has to do with what is going on in the world with transactions. You guys are popping in quickly here, so wow. Everybody's interested in this subject, and I think given where we see the activity and the outreach from people, we believe that too. So thanks for joining. We did this webinar in June, and there were a lot of question marks going on in June. What we saw was that the world really hit a pause from March until June, and mainly because everyone was really busy. If you guys remember that, I think we're 8 months into this now, and it feels like a lifetime, doesn't it? But everyone was really navigating their own companies and sort of paused on transactions. What has happened since then can't be any further away from that. So I'm very excited to tell you guys about what's going on now. We know most of the answers to the questions we had in June. What we'll do is commit ourselves to updating you at least quarterly on what's going on in the world, and give you the opportunity to ask questions and understand we don't have all of the answers, but we can tell you what we see. So a couple of quick reminders before we go. I'll have about 45 minutes of content, and we'll take questions. You guys have the ability to speak with each other through the chat bar, so feel free to use that. Also use the Q&A bar, and I'll watch that as we go, but also we'll stop at the end and take some questions. Also want to let you guys know, and this is new, so I didn't get the slide in about it, that we have made a proactive decision to postpone our February shift event. I know that our events get a little confusing, and people always talk about that hinge thing or shift thing or thrive thing. So we are Hinge, that is our company name. Our one-day financial deep dive is Thrive. We held that remotely and very successfully. We're really pleased with that. That happened in August. We moved it up a month to get it in before school started and to try to support people a little bit better. That recording is available for purchase. So plug into that if you have an interest there. We may actually do that twice a year with a combination of recorded content and live Q&A and social events. So that's our one-day event. Our 3-day conference shift, which we got in February of this year, just before COVID, was scheduled for Newport Beach for February of 21. And we're really excited about that venue. It's a fantastic venue. And we have made the decision that we feel like the content we deliver is important, but really meaningful connections with others in the industry is what we feel is the greatest value we bring in that event. So that event has been posted to September of 21, same venue. We're almost 100% on the dates. We're wrapping up an outside vendor that is associated with a fun event we want to add in. So we'll announce the date soon, but we feel confident that we can all get together safely in September. We're not quite as sure about February. There are a lot of predictions in the world. I think we have another 6 months of things to deal with. And the name of the event is Shift. And you can find that at shiftchildcareleaders.com. Thank you for that question, Pam. Keep your questions and chat going as we go. Like I said, I'll monitor that, and I want to be sure that the information that we give you guys is what you're looking for here, and take this in the direction that makes sense for you. So here's what we have planned. A couple of other announcements coming up. We want to talk about opportunities for growth. We want to talk about what's actually happening in processes and our values changing. That's everyone's big question. And then we'll talk about next month's webinar. So a couple of quick announcements here. We are so excited that we have invited long-term friend Rusty Bailey to join the Hinge team. Rusty has a 30-year career in the industry. He's a financial analyst and he worked at Childcare and then Nobel Schools, which was acquired by Spring Education, I think last year. So Rusty has a lot of history in the industry. He understands numbers. He's fantastic to work with in an area that's difficult for a lot of people to talk about. So Rusty has joined our team as our financial analyst. That allows us to look at your numbers faster, give you more feedback. He runs valuations for our processes, and he'll also support clients through the process with their financial diligence. So we couldn't be happier about that. And welcome to Rusty. He's been with us a couple of months now. I mentioned that our one-day financial deep dive that we held in August is now available on demand. So you can pick that up at, I think, thriveworkshops.com. I'll look. Oh, on our website. Okay, hingebrokers.com. Thankfully, I have smarter people than me in the room. And then, just to get this started, I want to tell you a little bit about the deal flow just the Hinge team had since COVID and what that looks like, and what it looked like then, what it looks like today. So as you can see here, we have closed 3 transactions since COVID, but here's what it looks like by the numbers. When COVID started, we had 8 transactions in under contract and moving toward a close. Of the 8, 3 have now closed. So you heard me mention, I thought, okay, we're about to do a 2-year shutdown of processes like we saw in the last recessionary period. That's actually what happened. People just took a real let's wait and see approach, and things didn't get closed for about 2 years. So we hunkered down, we were ready. Any of you that were with us at Shift in February in Miami might have attended my breakout session on recession proofing. That was about the fact that it's been 10 years plus before COVID since we had a recession. And there were a lot of people not prepared for it. People that lived through it before, like me, knew I better be prepared for the ability to pay my bills for 2 years in case there's 0 revenue, because we only get revenue if deals close. And that actually looked like it might happen for about 3 months as things paused. So we, at that time, had 8 transactions under process. What happened in about June was that most of those deals started moving again as buyers got grounded. So of the 8, they all started to perform pretty well in their recovery. We're measuring recovery by FTEs and revenue as compared to the same period last year. So what we hear nationwide today is there's about a 65% average recovery, with the range being, of course, some people didn't reopen. And surprisingly to us, I also thought we're going to immediately get phone calls from troubled assets that are desperate to do something, and we better be ready to help people. And we have not gotten those calls. So in June, we said, well, PPP money will run out this month or next month, and then the phone will ring with distressed calls, and it didn't. And then we said, well, they made it through the summer, but in September, when school goes back and enrollments don't return, the phone will start ringing with distressed calls, and it didn't. We do know that there are distress situations, and we do hear about schools that are not reopening. That's not largely what we hear. So of the 8 that we had under contract when COVID started, in June, 6 of those started moving again. The 2 that did not start moving again were because 3 of our historic national buyers are still pausing on closings. It'll probably be early next year before they'll kick back in gear. And it doesn't at all relate to how our sellers are doing. They're doing very well. But of the 8, 3 have already closed. So you see here that just in the last month, we got 3 of those closed. 3 more will close in the next 4 weeks. And 2 of those will probably stall until next year. And again, not because of performance of the seller, but because of objectives of the buyer. I've got a great question here, but I'm going to finish telling you what the deal flow is, and then I'll hit this for you. So that was what happened with those original 8. Since COVID, we have launched 6 new transactions. All 6 are under contract today at prices we would have expected in 2019 or higher. And I'll explain more about that as we go. Over the next 2 months, we will launch 4 pretty sizable multi-site transactions, all strong performers, all interesting, with a combination of owners that want to exit and owners that want to gain financial partners to stay in and help them grow because they believe this is an incredible time to grow in the industry. And then we have 2 more possibly launching, and so many in discovery, which is our valuation process that I can't really I didn't have time to add them up. So a lot. I think we're busier today than we've ever been in the history of the company's 17 years. Someone is asking me, what does 65% recovery mean? So we're measuring recovery by FTEs or revenue. So what that actually means, if you were to look at October of last year in your school, and you would look at how full you were, how many FTEs, full-time equivalents, or children you had in the building versus where you are right now. So let's say you had 100 children last year at this month, and this year you have 65, you're 65% recovered. We also measure that by revenue because FTEs are a little bit different right now. So you can also do the same math with your revenue. But you really have to compare it to this period last year. Originally, we compared to February of this year, and then once we got to the summer, summers can throw things off, so February might not look at like July. So then we started looking at same period last year to this year. You are welcome. Thank you for that question. And please keep those coming. Sometimes I throw things out and, you know, they're meaningful to me, but I want to be sure they're meaningful to you guys too. Okay, another question before I leave it. How do you calculate an FTE by average tuition or attended hours? Most people do it much more simply than that. Most people count a full-time child as 1 FTE, a part-time child as a half FTE. It's not completely scientific, right? Because you've got some after-schoolers on a couple of days a week and then not, but that would be part-time. You add those up and you divide it by your license capacity. So in recovery, you would add it up and compare it to what it was this month last year, and then divide this year into last year. That will give you the recovery percent. If you need help navigating that math, just reach out. We're happy to help. And yes, we will be sending these slides out. They will come from Carrie tomorrow. So that's what's been happening over here at Hinge. We're gearing up for a lot of work. Like I said, we've added to our team. We're working people pretty hard. So we're excited about that. Okay, so I spoke to some of this in the opening, but where we see things right now is we did see about a 3-month stall of processes from March till June. Then we saw buyers during that time, and then early summer, they were keeping deals warm, meaning they were reaching out. They weren't actually progressing, but they were reaching out with their good intentions to close. And and trying to keep relationships high, which was difficult because not only was it a stressful time to operate in, sellers in process had even more than that to deal with. Some of those had already announced to their teams. Some of those had, exit plans. So it was a lot for some people to navigate not only what was going on in their schools, but what was happening with their process. We have now seen the majority of our usual roll-up buyers. So a roll-up buyer is a buyer that owns schools already and wants to add to their portfolio. They've historically been the most aggressive groups in the markets that they're in, and in new markets if there is a multi-site group that gets them started in that market. We have 3 of those who have not rejoined us in processes and expect to next year. But the rest of those have been super aggressive because their thought is that there's less competition for assets. And also they believe that the industry will be much stronger after COVID. And we all have our opinion there. I'll tell you more about why. We're seeing aggression from Europe's childcare providers in purchasing and expanding assets in the US. And secondarily, from roll-up buyers, private equity groups who want to invest in the industry are showing a lot of aggression as well, because they also believe that the future of the industry is solid and bright. So some of our sellers go to a roll-up organization that would have them enter their current system and become part of their family. And if some of our sellers are large enough, they could be a target for a private equity group that's not yet in the industry that wants to get their start by purchasing a larger group. So we're doing both right now. Then also, like I mentioned earlier, we have some people that want a financial partner to come in, sell part of the company, let them take some money off the table, and let them keep some equity in and partner with somebody and then use that partner's money to grow. So there is a good bit of that going on as well. And like I said, closings are happening, so we couldn't be happier for our clients. It's really nice to be able to say to people, I know that this has been difficult and for different reasons, people want to exit. And it's nice to have options, because during the last recessionary period, it was difficult to try to help people without buyer options. That's completely not the case today. So what we're seeing when we do hear about and see troubled assets, and by troubled, I mean, I would say if someone's less than 50% recovered, they're probably struggling from a cash standpoint. We don't talk to that many people that are cash flow negative, but there is some of that still from people who haven't recovered as well as others. It was difficult to navigate how complex the last 8 months have been, with decisions about openings and closings and cleaning protocols and parent protocols, visitors, what is happening when there's a COVID situation in the school, what is the cash flow like? How can I keep my team engaged? Where can I get teachers? Initially, they didn't want to return because they made more money somewhere else than their teachers who might be older or immune compromised that don't want to return. So we're hearing reported issues of staffing, which is something we've dealt with for many years in the low unemployment environment we had before COVID. So we're not new to that, but it's just another thing to deal with. We are speaking with sellers who are personally vulnerable because either because of their age or their health. And then any schools that either struggled pre-COVID, or I will also say schools that were ramping. So if they were newer and they hadn't fully ramped, they're really, unfortunate timing for them, because it's difficult to go beyond what you already had, and just to get back what you had is a challenge. So a double challenge for people that weren't full already before COVID. Then we have our main group of high quality rebounding assets, or companies that are performing well, that want to exit or want capital to grow. So that's what's happening with buyers and sellers. So we reported in June that the process and the values were less predictable. That's not the case anymore. And because we have history since March to predict what values are going to be. Historically, we have based values, and it makes sense, on what is actually happening in the market. And in my 17 years, both business and real estate values were at an all-time high in 2019, with a lot of competition for assets. We are actually still getting 2019 prices and then some, but there's a difference in the process. So I'll explain that. Okay, actual value changes. So the first thing we heard was from those who were really trying to be competitive, and it was a very competitive landscape for buyers in 2019. They hoped we were going to have a pricing reset, meaning prices would decline and it would be less expensive for them to buy. And that's not actually what has happened, but that was everyone's first reaction. We hope we're about to have a pricing reset. That isn't actually happening. We have closed some real estate transactions, and those have actually decreased very slightly, about 0.25%, it looks like. But most of our institutional real estate buyers don't expect that to last long. Most of those are saying that they expect pre-COVID values to go back to normal in 2021. But it actually didn't change enough for us to feel like it was a bad strategy to go ahead and move real estate now, just because it's changed slightly, but not drastically. Good question, Susan. I'm gonna save that till the end. Thank you. That's a great one. Okay, so let's talk about the process. And if you guys I've taught this many times, and I hope what somebody on my team this week said, this sounds like the same stuff with some tweaks. And I said, I hope you find that as comforting as I do and as our clients do, because the way we react financially and the way that we manage processes does change, but it changes slightly and changes more in theory than practice a lot of times. And once you get familiar with the process and the steps and the valuation and what a financially healthy school looks like, you're not going to have to reinvent that every year. You might have to tweak it a little bit. But as you begin to learn it, you can add to that knowledge every time without the thought that, okay, I've got to completely rethink this again. It doesn't change that drastically. So here's what the process looks like, and I'll point out the parts that have had a major change since COVID. We have our pre-listing phase. I'm going to go into more detail about these. What happens before a listing ever happens. We have the marketing phase, what happens when we're seeking buyer targets. We are now moving all transactions during COVID to a two-part process, which I'll explain. Well, I think this is where I have to explain it. Typically, this was something we did only on large transactions. So those would be with schools of a group size of 6 or 7 and up. But now we're doing it on all transactions. So the two-part process means that when you get an offer, we want an IOI, an initial expression of interest, before anyone gets to come and visit your school. And this is for safety reasons. So we put together a very comprehensive marketing package in the marketing phase. And after people sign confidentiality, they get access to that, but they have to give us an offer before we consider them as a visitor to the school. And after they visit the school, then they get the opportunity to present their actual offer, which comes in an LOI, a letter of intent. And then we start to negotiate. It does make the process longer, but we really feel pretty strongly that that's the best way to navigate the process right now between buyers and sellers with everything that's going on in our schools. Every transaction has buyer and seller transition teams, and then the Hinge team on our side coordinates those in a series of actions during diligence, which is next, to navigate that process and to communicate effectively. We have certain protocols we go through that make that happen quickly and make it happen efficiently. And we're actually getting closings done maybe even a little quicker than some of those we saw in 2019. So scheduled closings for this year, if they stay on track to the extent they should, will close quicker than the majority we saw in 2019. Diligence, I'll explain in a little more detail. Along with diligence comes the definitive legal agreements, which is either an asset purchase agreement or a purchase and sale agreement with a lease. An asset purchase agreement purchases both the business and the real estate. A purchase and sale agreement purchases the business and the seller enters into a lease. We have to go through licensing. We'll speak to that. When do you announce to staff and parents? And then of course we close and everyone celebrates. So the pre-listing stage, this is our internal information gathering stage at Hinge. We're getting to know the client. We want to know about their school. We're asking a lot more questions than we used to. So today we need to know whether they were closed or not, what the environment is in their state and in their county. We want to know more about their recovery. We want to know, okay, good questions. I'm gonna get to you guys. Keep them coming. So there's a lot more information that we're gathering now than we would have before based on recovery. But we collect information that's required for us to perform a valuation of the business and the real estate. Those look very similar to how they looked before. We don't actually name prices on our listings anymore. We let the market determine the price. And the real reason for that is in a changing environment, we don't want to pin ourselves into something that we often find that a particular buyer objectives make them be super aggressive on pricing at a value that's above where we would have listed it. So we don't take the chance that we leave money on the table anymore. After we collect that information and we discuss the numbers with our potential seller, we want to see the school. So I don't think we've ever sold anything that we've never seen before, and we need to be able to speak to it intelligently. We did almost shut travel down completely until late August. I think Henry went on a trip in July. He was the brave soul in the company. But we started traveling, and I've been on the road every week for the last 7 weeks. We're doing our touring after hours and on the weekends now. So that just requires that we're very flexible in timing. We have created Hinge toolkits. I should have brought one up here, but we are giving our clients Hinge branded toolkits. You guys might like this idea for your parents that will begin to tour if they haven't already. And in the box, the toolkit box, are all the safety protocols. They get a Hinge branded mask, they get hand sanitizer, gloves, one of the keypad punch things so you don't have to punch the keypad with your finger. They get booties for their feet. So we're trying to promote the culture of safety that we know that our sellers and buyers expect, and the fact that we take that very seriously. So we are now, when we used to tour during operating hours, there's some ways we do it that we like. There's certain things that always work, and happy to share those with people when we get back to that place. But we're also fanatical about confidentiality. And this is often people's main concern. And it actually almost never happens that we have a confidentiality breach. We have had some. We've had licensing people call the school and say, I'm calling about the transition to your new owner. And we coach licensing really closely because sometimes a person wouldn't have gotten the word. And when something, and again, maybe this happens every couple of years, it's very rare. We just say to the team, it was somebody new on the staff. They shouldn't have called. They didn't know what they were talking about. And it's really for the health and well-being of the team, because transitions go really well from repeat buyers. They understand that if they don't do that well, the asset they are purchasing is at risk. So it's as much or maybe even more to their benefit to wait until communication can happen between both parties in a comforting and secure environment, that people get their questions answered. And they mainly promote themselves to the staff, because if the staff are happy, parents are happy. And they do communicate with parents, but they really work hard to engage the staff, let them know that they're secure. They largely keep everyone, that's their intention, and to be sure that they're happy and they feel supported and excited about the transition. So we've had to make a couple of shifts in the way we do touring. It's actually made confidentiality easier because we're not there in the day. And so that's been a positive. We begin diligence gathering here. We're adding in, like I said, more metrics on recovery, because we need to understand that and advise people on the process, which and the structure, which I'll talk about in a minute. And then if we're all happy with how the numbers look and we believe that we have buyers for that person, so we don't charge fees to do a valuation. We don't charge retainers like a lot of brokers do to cover our expenses during the process. So it cost us a lot of money in travel and people and processes to get somebody listed, but we take that risk along with our sellers that we can get that done for them. So we really only take listings that we believe we have a very high chance of getting accomplished. And we almost never lose on that. Sometimes it takes us longer than we hoped it would. I've got 3 or 4 right now that I'm just on a mission. I'm just determined to help these friends move their companies, and we haven't quite yet done that successfully. But that's okay. Timing is really important, and we take that very seriously. So once we execute the listing agreement together, then we're off and running. This is the point at which we decide who would be a good fit. And like I said, change here is that some of our historical buyers are pausing, but there are new ones who are even more aggressive entering the mix. At the Hinge team, we sell to, our buyer database, there are over 300 companies in our buyer database. Our buyers have cash to close deals. So those are the buyers that we work with. We don't work with individuals who are entering the industry for the first time. We do sometimes work with current owners that have a couple of schools, and not that there's anything wrong with that. It's just not the Hinge model. So our buyers are cash buyers or buyers who are experienced already in the industry. So we give a list of those buyers who we want to market to our sellers. It always really surprises me when people have their companies out in the market and they have no idea who the broker's talking to. You should always know who your broker's talking to. You should approve that list of buyers. And then we talk about the good and the bad of the buyer list, because likely we've closed transactions with the people we're promoting it to, and they're not all perfect, like none of us are. And some of them do parts of the process better than others. And we're very honest with our sellers about that, because we want them to, often they'll get multiple offers in the same range. And those are the kind of factors that determine their decision. How much quality will they run afterwards? How will they treat my people? How long will the process take? How burdensome are their legal agreements? So we talk about all those things. We without the buyer knowing what the transaction is, we have them sign confidentiality. Now they're legally bound to keep it confidential. Then they get the information that we have created that includes a very nice marketing piece that Jacqueline on our team puts together. And change there is that we've added a lot of data about the recovery and where that company is in their recovery process. Again, buyers prefer to tour during working hours. Usually I do too. You get a much better sense of the operation when you do that. So historically, we would meet off-site. We will only come through a building once, and that's during the listing process. But we manage the tours, so we're there. We usually introduce the buyer and seller. We have decided beforehand how that person will be introduced, and they tour, and then we come back together to discuss any questions they might have had. Now we're conducting tours. I have done a couple of tours myself during operating hours with a lot of safety protocols in place, but there are no buyer tours during operating hours right now. Those are all nights and weekends. That's how we're managing it. So the main change in the industry and the way transactions are going right now is that in 2019, our sellers could expect cash at close, walk away, we're done, or all cash at close, and now we're business partners and we're moving forward to grow this company. That isn't happening. Well, actually, I won't say it is actually happening, but here's how. When I say structure, what that means is the payment is usually structured in a way that part of it is paid at closing and part is paid in the future based on recovery. And if you think about that logically, if the average recovery is 65%, you guys who have been with me in financial workshops know that our profitability comes in that last little 10%. So most people at 65% recovery are probably at a break even. And if I'm asking buyers to pay you based on your 2019 performance, which is what I'm doing, then I have to convince them that it's okay for them to take that risk because you're already recovering and moving up, and they can pay you part of that in the future when actual recovery happens. What's that timeline look like? So know that the structure proposals are all over the place, and we are also asking our buyers to give us 2 separate offers now. So they can give us an all cash offer and a structured offer, and an all cash offer would of course be less than a structured offer where you're accepting some of the risk in the future. And most people's problem with that, of course, is if they're exiting, they have no control then over how well the school performs under new ownership. I like for them, if they have a team member who will stay on to incentivize, the director, the manager, to stay there and help with the recovery, then they know they've got some continuity and that person can be rewarded in the future when they recover and get their future payment. So we are closing some things in all cash, but they would be at lower numbers than the ones that would be full 2019 prices that include some structure. So structure is a little bit all over the place right now. We like for structure to at least extend into 2022. We think the calendar year of 2021 will still be a little volatile, and maybe just the first quarter. It's my opinion, and look, we all have one, right? Some of us are guessing right and some of us are guessing wrong, but we're all guessing because we don't have any history to base our guesses on, and that's what makes them a guess. So I think we have 6 more months of this. I think that we will continue to rebound, and we're doing it, we're feeling it. But I think that we will be dealing with some level of rebound until about March. So we don't feel completely secure that 100% recovery will happen in the calendar year 2021. It may happen by spring or summer, but if you look at the calendar year, because of first quarter, we believe it probably won't happen. So we want to look at 2021. If you rebound in 2021, you get your final payment, fine, you're done, see ya. But we also want to see at 2022. If you don't meet it in 21, we want the opportunity to have one more year to look at it. And as I'm talking through this, I'm talking about it from the seller standpoint, because that's who I usually talk to. But a lot of our clients are also growing. So you can flip everything I'm saying over and grow with it if that's the mode that you're in. So structure, some people are basing it on FTE recovery for a certain period of time. Some people are basing it on revenue recovery. Some people are basing it on EBITDA recovery. We prefer FTE or revenue because it's faster to prove and it's easier to define. So when somebody takes your school over, then EBITDA, which is earnings before interest, taxes, depreciation, and amortization, it basically means cash flow recovery. It could take longer because of new protocols and the addition of staff members. If you guys haven't had access, go to our website and pick up my ideas on making some changes in your school that will help you afford some of the new expenses that you have going on right now. So more structure in deals. In the diligence process, there is information that has to be provided around all of these areas. Things about your company, things about your facility, with financial statements and tax returns, information about your employees, their benefits, their pay. What do you do in your operations? How do you market the company? What systems do you have? What legal issues are there? And then what's your real estate like? We have mainly seen changes there around the financial bucket. And again, it relates to recovery. I will say I didn't have a chance to add this because I just got this last night. I just got the new protocols. I'll send this to anybody that wants, and yeah, there it is. There are a lot of questions around if we close a transaction with a PPP loan in place, how does that work? And the protocols just got announced. This is effective October 2nd. It came from the SBA. And basically what you do if you haven't gone through or the ability to get it forgiven hasn't happened yet, those funds for you to repay the loan get escrowed at the bank that set up the loan for you. So they're held there. And you don't get all of the closing funds, and the SBA won't take the risk that you will then pay that loan off if you owe it. So those funds have to be escrowed at the bank when you close. So that's been a very recent change that just got announced in the last couple of days that we're working with. I explained the agreements. I think that I think there was a question about the agreements. I'll hit that in a minute. Buyer licensing. So when we went into closing deals again, we thought licensing is going to be a nightmare. Our experience with licensing transitions, so it isn't always required that you have a licensing transition. It depends on how the deal is structured. But they're usually structured in a way that it does require a licensing transition. And that experience is so vastly different. And it's not just by state, it's county by county, person by person. And sometimes you really don't know what experience you're going to have. We will say that when sellers have a good licensing relationship, it goes much better. But we have not actually seen delays in licensing. They're moving forward just fine. And we're real proud of the work that they're doing and helping sellers navigate that and helping buyers get new licensing. So this slide was a holdover from June when we thought, you know, what in the world are we going to deal with? You know, licensing can be challenging enough, but what to expect now? That's actually been a good experience. When do you tell the management? I spoke to this just a little bit. We like for managers to know ahead of the rest of the team. We want them to feel secure and have the ability to meet people, build relationships, be a part of the process, and get their questions answered and feel good before the rest of the team and parents know. When the rest of the team knows, parents are going to know. You know, they won't get out of the meeting good before they're texting someone. So that's why it's so critical to really market to the team and be sure that they're comfortable. The majority of those happen, management might know a couple of weeks ahead of closing. The rest of the team and parents will know about a week ahead of closing. That makes some people uncomfortable. our experience is that it goes much better for a couple of reasons. First of all, they don't get blindsided by, oh, we just closed today or yesterday. They got to think through it and get their questions answered. Also, it takes time to get employees shored up with payroll and benefits and get new systems in place. So it just goes much better. We do want legal agreements to be completely negotiated, if not executed, before those announcements happen. So that's an important part of the process. Same thing with parents. Usually, management will know a couple of weeks ahead of time. Teams will know a week ahead of time. The parents will get a letter jointly written by the buyer and the seller the next morning, and they will look at the staff and say, are you cool? And they will say yes, and everyone will be fine. That's how it usually goes. Then we close. So predictions for the future, and then we'll take some questions. I think that you guys will continue. I know we've got a little drag here in support and federal relief, so who knows where that will go. It's really been very state specific, how people have been supported, whether grants have been available. I've got some clients saying, I have more cash than I've ever had in the bank. I've been so well supported. I'm getting paid for students, whether they come or not. And then there are a lot of people in areas that are struggling and support isn't as widely available. I think there will be continued support, largely though. We believe, and the buyer base believes, that our industry will become more and more highly valued in the world. You guys have been under-recognized forever. I'm 34 years in this industry, and I've never felt more support and recognition and positive news about the industry, and that makes me so happy for you guys. So the incredible investment in the industry is largely related to the fact that the investment community believes that you guys will continue to be more highly regarded. That means you have more access to funds. It means banks look at you more highly when you go for a loan. It means you have the opportunity to sell at higher dollars. It means you have the opportunity to raise your tuition rates higher. So that's a positive. We think there'll be more opportunities for you to grow. There will be troubled assets. I know you guys are hearing about some. I suggest that you approach that seller, or maybe it's not even a seller, maybe they're just going to close, and see what you can do to help in a way that might strengthen your company. Are they close enough that you can say, if you will help me transition your staff and your parents, I'll pay you something for each one? Do you have equipment I can buy? Or maybe you just want to go into that location, but be on the lookout for those. And we also believe that values will remain strong. So let's see what questions you guys have. There are a lot, and I love that. So, there are talks of a recession, job losses, devaluation of the dollar, commercial property value decline. Can you speak of this? Yeah, Jennifer, I see the talk. I hear the talk. We are certainly not feeling it. And we're not feeling it from our buyer base. A lot of them are drivers of economic factors because they're investing money in industries and they really like ours. I can only speak to what I see, and also say that nothing would surprise me because I've been surprised so much since March. Conversations with licensing in California has been positive concerning transitioning because there's such a need in childcare. Thank you. California has certainly been a difficult market for providers to navigate and slow, really, for processes to open back up. To what extent does cooperation or lack of cooperation on landlords impact the school's recovery or ability to sustain the business? It could, right? So we counseled our clients early on to ask for some rent relief from their landlord, and most people did that successfully. Landlords largely don't want to have empty buildings, and they were agreeable. I think the average was most people got about 4 months of rent relief. And it's not too late to ask for that, guys. Don't be timid. Your landlord does not want an empty building. and offer to amortize that amount over the rest of the lease or put it at the end of the lease. Some people are also asking landlords to make investments into their building that need to happen now. You need to rebrand, you need to spiff things up, it needs to look good for your future. So that's another trade-off. When is recovery expected to be what it was in 2019? Well, that's a great question. I gave you my opinion. I really think that we're looking at the spring. There are opinions all over the place. And if you look at calendar years, I think it's going to be 2022. But you guys weigh in. Your opinion's just as valuable as mine from a business standpoint. Gotcha. What are the range of multiples on EBITDA we've seen in transactions that have closed during COVID? How will those multiple changes? I said they have increased, actually. So the range of multiples is anywhere from 3 to 14. So let me give you the landscape of multiples. What sets the bar for the multiple is the national transactions that trade. And in the last 2 or 3 years, 3 of those had traded. All 3 have been at a 14, all-time high, 14. What happens from there is if those guys are worth a 14, then they can roll up things at lower multiples and they're immediately worth a 14. So that's the roll-up strategy. You could do this if you're at the size and you're a 6 and you can buy anything less than a 6. It's immediately worth more to you than it was what you paid for it. So I will say that since COVID, the values are just the same as 2019 or higher. It's really more related to the dollar amount than the number of schools. We have a transaction with more than 2 million in EBITDA at about a close to a 10 multiple. We have things under contract in the 6 to 10 school range at $1 million to $1.5 million in EBITDA. In the 6, 7 multiple range, we have single centers under contract in the 4 multiple range, and maybe one in the 3 range. So it depends on the deal size. This is why growth of your company makes everything more valuable, and why the roll-up strategy is so successful. Why will transactions close more quickly compared to 2019? I don't know. That's a good question. I think that, you know, it may be driven by seller objectives. So sellers who want to exit don't want to continue to take the risk, and they're willing to work more with buyers that can get it done quickly. So we also, another thing that's driving that is a lot of our sellers believe that if we have a change to a Democratic president, that certain tax advantages might go away in 2021. So they want to close in 2020. How have labor costs changed during Corona? What do you expect to happen after? They've gone up, of course. We've all had to add people who do things like help children get from the car to the classroom because parents are not coming in. We are not combining groups, so that drives labor cost up in the morning and the afternoon. We are doing more cleaning, that drives labor costs up. And I think some of that will stick around for a while. I don't think we'll change those things, and maybe we'll never change some of them. I think maybe some of the cleaning protocols will stay in place. Again, I suggest that you look at our recent information about how to balance out some of those costs with other changes in your business structure. We do not get appraisals before setting a selling price. And I assume that you mean for real estate, Diane, because we perform valuations for business, which is what an appraisal is to real estate. And here's the reason. There are certain metrics to what your real estate is worth when your business is in it. And I know that sounds contrary to how you think about real estate. You know, the property next door sold for this, so mine should sell for something similar. That's not how it works when a business is in it. It's largely driven by the economic value that the business can generate for that real estate. And if you want to know more about this, we do have a webinar on setting real estate prices that goes into great detail about this, but we don't do that before setting a price. As a matter of fact, our real estate buyers do not do appraisals before closing. They want to know that the business is viable. They're betting on the business owner to pay them the rent, and that's what they base their value on. It is not based on what you would consider a traditional appraisal. Are you seeing national buyers tack on earnouts to current deals? If so, how long and what terms generally? I think I spoke to that. So an earnout is the structure I spoke to. It just means a future payment based on economic factors in the future. So hopefully I gave you that answer. Have banks changed their loan to value ratios for lending on schools? No, I see people getting the typical metrics from banks. And of course, interest rates are really helping people want to do more investment in real estate. How do national players tour schools during coronavirus? I think we mentioned that. I understand you don't set a price now, but how does the seller know what to expect? Well, we tell our sellers what to expect. So good question. We don't set prices, but we counsel our sellers based on what is actually happening in the market. So when the few brave started to list in June, we had, we said, all we can tell you is what happened in 2019. We have no idea. You might be the first one to answer the question on how buyers will react now. And we were very pleasantly surprised that it was very much on par and sometimes higher with 2019. So like I said, we have 6 transactions that have launched and are all now under contract since COVID. I think one of those, maybe 2, is about where I would have expected last year, and the other 4 are higher than I would have expected last year. Who are the active national buyers during coronavirus? I probably would not want to talk about them without their permission, but if you want to call me, I'm happy to maybe give you more information. Will Hinge handle an amicable sale of a childcare center to an employee? Sure. What's the fee structure depends on the deal size. So this is something that we talk about a lot. We don't have set prices for things. I'll tell you what the industry norms are. Business brokers usually charge 8% of a business value, and real estate brokers usually charge 6% of a real estate. We rarely get as high as those numbers. And depending on deal size, it can go much lower than that. So we always have to know the deal size first. Do we have suggestions for brokers for single center owners? I've been told you don't work with that. Well, that's not true. That aren't large enough. Okay, well, maybe. So how do you find one? We do work with single center sellers. Our particular buyer base usually wants an EBITDA or a cash flow over $100,000 a year. And sometimes that's hard to get in a smaller school. So it's not that we don't want to work with you. It's just that our buyer database isn't suited for you. And this is a tough question, and I'm glad you're asking. And I'm so super picky about who I recommend to people to work with. I'd probably need to know where you are, because there's some good state-specific brokers that I like. Other than that, it'd be difficult for me to tell you who to work with, because again, I'm pretty picky. What are we seeing in terms of EBITDA margins for companies we're able to successfully sell? So anything over 100,000 per school. We actually have schools with $1 million a year, single schools in EBITDA. So the range is vastly different, but our particular buyer database is looking for 100,000 plus. I missed that. Are you basing valuation on EBITDA? Yes, EBITDA or cash flow. I'd love a copy of the info on closing with a PPP loan that's not been forgiven. We will put that out along with the slides tomorrow. So happy to give that to you. How long will it take to close deals before full recovery happens? If it's business only, 4 to 6 months from start to finish. Sometimes it can take longer. And the wild cards really are attorneys and how the spirit of attorneys to get a deal done and not to drag on agreements and not to over Due on agreements is probably the biggest factor. In some states, it can be licensing, but we're not having that right now. So a very cooperative spirit there. Couple more. We're bumping up against your time, so I see we're there. If your childcare center was at the announcement to management stage when COVID hit in March and went on pause because the buyer usually go back to diligence or pick up where they left off. Okay, good question. So if you were about to announce or you announced and that means you were about ready to close, what will happen? What we're seeing is they're just updating information on the current financial situation, and then they're moving to close. So we haven't seen any structure changes. The ones that were, well, yes, we have. A couple of those have moved from all cash to now a structured deal. So you may see, in addition to update of financial metrics, you may see a change from all cash to cash plus structure. And then multiple is times gross income, net income, or EBITDA times EBITDA, or cash flow. And we get that question a lot. You know, one of the things for you to know is that often we get the question, what are the multiples? And that's an important question, but the most important question is what number are you basing that multiple on? Because we know what the market will do and how it will look at your numbers. And we're worried that some people leave money on the table because they don't know they can add back certain expenses. And we take a pretty aggressive approach on that. Sometimes certain buyers will try to talk us out of things, and that's fine. But we largely know how we can present the numbers in a way that maximizes the EBITDA. And then last one, have the deal values come down in light of higher labor cost and lower FTEs? No. Not at all, even though valuation multiples may be the same as 2019. No, so valuations are the same things. The deal, I think what you're asking is, are we basing it on a different EBITDA? We're not. We're basing it on 2019 EBITDA, and at, you know, our projected value is at 2019 prices or multiples, and that has proven to be true. So all really, really great questions. You guys are on it here. I will quickly check the chat bar. I think looks like we're good there though. A couple of, okay, we are. And we are bumping up against the hour. You guys are fantastic. I think we got to all the questions, but if not, we'll get to you on it. If we didn't fully answer your question, shoot us an email. We're happy to help. We are going to, we have not set the November date yet for the next webinar, I don't think, but maybe we have. Let's look at the slide. Like I said, my team's on this thing. Yeah, no, we haven't. So we'll get that date out to you. We are focusing this year on your reimagine of your business and the opportunity to use this difficult time to set yourself up, not just to recover in the future, but to be even stronger than before in the future. We are currently developing our 2021 webinar series with even more ideas for you guys to come together and to make your school the best that it ever has been. So thank you for hanging with us for an hour. We'll also keep quarterly updates on what's happening in transactions. We wish you all good health and safety, and we're here to support if you need us in any way in your school's recovery. Take care and be well, friends.